Good day folks, Jim here from Orchard Forex, and it is Sunday the 14th of February. I'm going to do a shorter video today because the FX markets were pretty choppy and uninteresting last week, with the dollar ending up reversing most of its early gains and finishing towards the lows, albeit in a very tight range. And I'm pretty non-committal over the next few days, although sterling begins to look increasingly interesting on the chart, so we'll go and have a look at that in a second. Elsewhere, the stock markets, the S&P and the Nasdaq closed at yet new all-time highs, so that trend keeps on running. While oil, West Texas Intermediate almost touched our long-held target of $60 a barrel, and we'll go and check that out as well. Looking ahead, the calendar this week is a little bit thin. The main interest comes from the minutes of the most recent meetings held by the RBA, the Fed and the ECB. Other points of interest will be the EU Q4 GDP due on Tuesday, the UK January CPI and the US retail sales will be the focus on Wednesday. The Australian jobs data for January will be released on Thursday, and then finally we get the global flash PMIs and the UK retail sales on Friday. China will be out all week for their New Year holiday celebrations, so it's likely to be a pretty quiet week in Asia, and it's likely to be politics and I guess company reports for Q4 reporting season. They'll probably be the main focus of the week. But we'll go and have a look at the charts and see what they've got to say. So starting here with a weekly chart of the US dollar index, and basically it reversed the previous week's gains. Trading really between 90 and 91, the figure, so 1% range really. Well, actually 91 and a quarter, 90 and a quarter, 91 and a quarter, but it really did very little on Friday. And the indicators are looking pretty flat to me. They're not doing an awful lot. We might see, if I wind this up a bit, we might still be seeing a basing formation here, but the dollars are looking pretty uninspired. And while we've got this risk-on scenario with stock markets going ever higher, the need to buy the safe haven dollar, it seems to be diminishing somewhat for the time being. So I think we're probably in for more choppy conditions. As I say, I'm fairly uninspired by the direction for the time being. We'll go and have a quick look at the euro, and as you can see here we have a 4-hour chart of the euro, and it's just chopping around in this sideways action. The 4-hour charts do look a little bit heavy to start the week, but the dailies are returning to fairly neutral ground, and I really don't have much of a view on it at all. And the same really applies to most of the other majors. I'll just take a quick look at the Aussie. This is a 4-hour Aussie chart, recovered from its lows, but not really doing anything directional at the moment. We might see a little bit more strength in the Aussie. I still don't think we're going much above 78 cents early this week. The dailies might be pushing higher. Once again, if the positive risk sentiment does continue to hold, we probably will see the Aussie push a little bit higher, but I'm not really enthused. I think there are better things to trade. And on that basis, we'll just have a quick look at sterling here. So here we have a daily chart of sterling, and as I pointed out really since before Christmas, we had this reverse head and shoulders. Sterling was unable to break away from the neckline, but it seems that they may have done so despite some pretty poor UK data recently, but they're making headway with their vaccinations in the UK. So sterling reached up to a new 3-year high here. If we go to the weekly charts, that's back to April 2018. Let me just blow that up a bit. And it does seem that sterling, I think, is going to continue to outperform. The weekly indicators all look fairly positive, and I kind of like sterling. As a safer trade, it may be better to be long of sterling against the euro rather than against the US dollar. We'll go and have a look at euro sterling in a minute. But of all the currencies, as I've said, I'm not really inspired by any of them, but sterling is the one I particularly like at the moment. So actually, we're going to have a look at euro sterling now while I think about it. So here we have a daily chart of euro sterling, and as you can see right now we're sitting on the 61% support level, which is pretty strong support. From the whole move up down for 82 3/4 right up the way to 95. So we're sitting back here. It's taking its time to break through on the downside. I do suspect it's going to, though. The daily indicators look a little bit heavy, not an awful. If we go back to the 4-hour charts, they're not actually telling us a great deal early in the week. And this level here, 87.40, that's the trend low. So we need to get through there in order to push further to the downside. If we then go further out to the weeklies, we've really seemed to be breaking away from this 100 and 200 week moving average, breaking through on the downside. Once we can take out this 87.40 level, the next levels of support looks to be around this 86.60, and then if we really push on through, we can get down to sort of 85.25. That's some way off at the moment, but the weekly indicators do look a little bit heavy. So I think selling the cross into rallies, looking for further progress to the downside, especially once we've broken 87.40. That's what I'm really looking for this week. And I'm not going to spend any more time on the currencies, but we'll go through and have a quick look at the stock markets. So here we have a 4-hour chart of the S&P, and it closed right on its highs for the week, and all-time highs. I still prefer playing it from the long side. There's not much to be gained out of trying to pick the top of it, so I prefer the long side. But having said that, as you can see, we've got some bearish divergence building here in the 4-hour chart, so we need to be aware of possible setbacks. And here on the daily chart, we can see that the indicators still look okay to me on the dailies, and there's going to be support close by at around this sort of 38.80. If we were to get there, that's 50 points away. So I doubt we're going to get that down there on Monday, but if we were to get through that 38.80, 38 or 70 level, then I think we can probably come back and test this uptrend support here, currently at 37.30, but climbing with the 100-day moving average. That's a bit further away now, 36.15. But the dailies do look mildly positive. One word of caution, though, on the weeklies, we're very overbought, and we're seeing quite decent bearish divergence. So just be careful of that. The same really applies to the Nasdaq. We'll just kind of have a quick look there. Here, the Nasdaq daily charts, the indicators do seem to be pointing higher still, so stay with the long side. But once again, if we check out the weeklies, as you can see, we are overbought and showing bearish divergence. So at some stage, we're going to see a correction lower. I suspect it'll be a good buying opportunity because of the amount of funds that the US government are going to be chucking at the US economy to give that a kickstart, which is also happening around the world, of course. So I think asset prices will continue to become inflated, and any dips that we do see should be buying opportunities. Just moving forward to the Aussie market, not doing an awful lot at the moment. This is a daily chart of the SPY. The indicators are pretty flat. I thought we were breaking higher last week, but we've been unable to carry on, and the SPY has moved back down to around 67.70. That equates to around 68.30, 35 on the ASX 200. So the daily charts are flat, and I suspect we're probably going to track sideways for the first couple of days of the week. The weekly charts, I'm not really sure. I'm a bit non-committal there. The weeklies, they do suggest that we should continue to push higher, but time will tell, and I think it's going to be a long, slow process if we are going to do so. Moving on to oil, and here we have a weekly chart of the oil market, and as you can see, going back right to what's this 2014, June 2014, in this weekly chart, we peaked that top, and we've just touched it again on Friday. So this is going to be fairly significant resistance. I think if we can get through it, and the indicators, the longer term indicators are suggesting that we can, then I think we can probably head back up here towards this sort of 65 level. At $65 a barrel, I'd be squaring up. I think I'm not really quite sure where it goes from there, but keep an eye on it. I definitely think dips are worth buying, and I would keep a stop loss now, probably under something like sort of $55 if you can manage it, probably below the 200-day moving average at 53. But I think we're heading above 60 and going towards 65. Coming back nearer home to 4 hours on the daily charts, as you can see, the bulk of the move was made very late in the session. Markets were beginning to thin out a little bit on Friday. It's a 4-hour chart, so it wouldn't surprise me to see a little bit of a dip, some early profit taking up here around this sort of 59.75 level, moving back towards 59. But I think I'll probably be buying it there on the day, on a day with a stop loss below 57.25. I don't think we're going below there. If we do, we might head back towards that 55 level that we just spoke about. The daily charts, as you can see, this is a long-term trend line, and we've broken out of the channel. We've just definitely broken out of the channel that we were in, and we're pushing this resistance now beyond 60. Then, as I say, I think we can go higher, and the indicators are looking fairly positive all round. So that's about it for oil. Moving along very quickly to gold. There's not really anything going on here. It's just very choppy, with support down here at this sort of 1785, but well, 1785, 1765 level, and resistance up here, so 1870, 1850, 1870. I think probably for the time being, just trade that range. It's the way to go. Most people seem to be looking at Bitcoin these days, which I don't really get involved with, but it's becoming something that possibly we do need to start looking at. But in the meantime, I think I'll still steer well clear. So that's about it. We'll have a quick look at the calendar. I think Monday's going to be pretty much a write-off. We've got the Chinese New Year for a start, and then it's US President's Day holiday, so the banks will be closed in the States. So there's not an awful lot to report from there, I don't think. Having said that, Tuesday starts to get a little bit busier. We've got the RBA minutes and the Australian new home sales for January to be released. And then we've got the ZEW and the EU Q4 GDP. That's to come. Not an awful lot from the States once again. Wednesday, there's a minor speech from one of the RBA board members. UK inflation data. And then the US PPI and retail sales figures to come. And then later on, we've got some secondary data, capacity utilization, business inventories, that sort of thing. So, and then late in the session, we've got the FOMC minutes. So that'll be the main event of the day. Thursday, the Australian jobs data. Looks like we're expecting 50,000 jobs to have been created. And we'll wait and see on that one. There's then some Fed speakers by the looks of it, and some secondary US data late in the day, and then Friday winds it up, starting off with the New Zealand PPI, the Japanese inflation data, and we've also got all the flash PMIs, manufacturing, services and composite PMIs to come. And that's really about it. Once again, there's not an awful lot from the States apart from the PMIs and a couple more Fed speakers. So that's about it for the week. So all up, I think we're in for probably more choppy conditions, particularly in FX. Stock markets, I think, will probably slowly grind higher. Oil, I think, eventually takes out 60, possibly heads towards 65, at which point I'd be squaring up. Anyway, that's really about it for now. Leave you to it. Have a good week's trading, and we'll talk to you next week. Cheers.